This is the video lecture on the balance sheet. Now, the balance sheet is also one of the four main financial statements, and it's a very useful financial statement that will help us identify potential problems that we might encounter as a business. And there's basically three main qualities that we're looking for in any business. The first quality is called liquidity. Now, liquidity refers to the ability to convert assets into cash. We definitely need to be as liquid as possible as a business, because you never know when we're going to have last-minute debts, transactions that might occur where we are obligated to pay money. So we always have to have a good degree of liquidity to make sure that we potentially have enough cash money to cover that. It also helps us assess our solvency. And solvency is looking at the long term. Are we going to be able to satisfy our long-term debts? And it also helps us identify our financial flexibility. Are we flexible enough to be able to respond to changes, last-minute things, new things that are spontaneous? We want to be very flexible as a company. So all three of these are good positive qualities that we're looking for in any business, and the balance sheet will certainly help us tell whether or not we have these qualities. At the same time, the balance sheet is not without its limitations. And there are many different limitations. For one thing, all of our assets are recorded at the historical cost. Remember, we do have a historical cost principle. So, it's also possible that because of that, our asset values might be a little bit outdated because they are recorded at the original cost. We also have a problem that involves judgments. There are a lot of judgments and estimates that are used to prepare items that are on the balance sheet. For example, inventory, that's an asset. That appears on the balance sheet. Well, we know that with inventory, I could use many different methods. I could use FIFO, LIFO, weighted average, specific identification. So depending on which one I select as an accountant, that's going to change the nature of the information. So there's a lot of judgment involved in these amounts. And also there are certain things that are simply omitted because they cannot be measured. So for example, when you talk about assets, a lot of companies would say that the best asset they have are their employees. But how do you put a value on people? Or they might say the best asset of our company is our corporate culture. Well, how do you put a value on that? So things that can't really be measured are not actually included on the balance sheet. So that's a limitation. Now, in terms of the format, the main things that we're going to show on our balance sheet are the assets, liabilities, and equity. And as a result of that, our balance sheet is going to conform very closely to the accounting equation. In fact, one thing that we all know about the accounting equation is that it must always be in balance. In fact, that's why they call this the balance sheet. It gets its name from the fact that the accounting equation must always be in balance. So if you go back and look at the accounting equation, which you learned in your very first Principles of Accounting course, think about it. We're going to show on the balance sheet, we're going to show all the assets. We're going to show all the liabilities. We're going to show the equity. But even more importantly, we're going to show the relationship that exists. And the total of all the assets better be the exact same number as the liabilities and the equity. That equation always has to be in balance, and you will see that reflected in the actual balance sheet itself. Now, when we prepare a balance sheet, it's possible to prepare a classified balance sheet. This is a little different than the balance sheets that you might have seen in Principles of Accounting. The difference here is that a classified balance sheet takes the time to organize the various assets, liabilities, and equity into different classifications or different categories. So that's going to just provide more detail. And it's also going to help out those people who are calculating certain financial ratios. So they'll be able to look at certain categories or classifications to get the information that they're interested in. So in terms of assets, we're going to have various asset classifications. And we're going to talk about each one of these in detail, but they are current, long-term investments, property, plant, and equipment, intangible, and other. So like I said, these are going to be the 5 different possible classifications that we will utilize for all of our assets. So the first classification would be the current assets. Now this is to be used only for the assets that will be converted into cash within 1 year or the operating cycle. So in other words, the most liquid of all the assets are going to go in this category. These are literally the assets that within 1 year or an operating cycle of the business, they're going to be converted into cash. So those would be things like cash, receivables, inventory. Those are the kinds of things that would be included under this category. Then we're going to have our long-term investments. Now these are assets, and specifically they are investments that it's going to take longer than 1 year or an operating cycle to get the money. So as a result, these go in a slightly different classification, which is more of a long-term classification. Then we're going to have our property, plant, and equipment, or what some people would simply call the plant assets. And these are the long-term assets that are used in operations. So these are things like land, buildings, equipment, machinery, pretty much all the assets that are depreciated other than land. So all of those would go under this classification. Then we have a classification for intangible assets. These are assets that have no physical substance. So these are assets that you can't see, you can't touch them, they have no physical properties. So that would be things like copyrights, trademarks, financial instruments, things of that nature. And then finally, we would have a category called other assets. And we would be very particular and very limiting what we would put in this category. This is truly only for those rare times that we would have an asset that literally does not fall into any of the other categories. So those would be our classification system that we would utilize for all of our assets on a balance sheet if it was a classified balance sheet. Now, in terms of liabilities, there are fewer classifications for liabilities, pretty much only 2, and those would be the current or the long term. Current liabilities, of course, we know that liabilities are debts, and they are debts that have to be paid. So if the debt has to be paid within 1 year or the operating cycle, it's considered a current liability for sure. But if we have longer than 1 year or the operating cycle, it would be considered more of a long-term liability. So that's the difference there. And then under equity, we're going to have 3 different areas. And this is primarily because we're now dealing more with corporations. And these would be the 3 areas of equity. And this corresponds pretty much exactly with our 3 corporate components of equity, which would be the stock, paid-in capital, and retained earnings. So the stock, this is used for all the classes of stock. And it could be, at the bare minimum, the common stock, or if they do actually happen to also sell preferred, we would have a separate class for preferred. But both of those would be included under capital stock. Then we have our paid-in capital. This is reserved for additional money that was made by selling stock above par value. So anytime we do that, that additional money goes into the paid-in capital. And then finally, we have the retained earnings. And that is utilized for all the money that has accumulated from all prior periods. So net income, profit that we made in previous years that has never been paid out in the form of dividends, that would be held on to, and that would be included in our retained earnings. So that just gives you a breakdown of all the classifications. But ultimately, like I said, it's going to show the assets, the liabilities, and the equity, and it's always going to illustrate that accounting equation relationship so that everything is shown in balance.